And here we are, Gaius King, commodities analyst, Fox-Davies Capital. The oil price reached $96 a barrel last week, a 10-month high, which is clearly good for producers, bad for global inflation, depends which side of the equation you're on. Add to that the UK's taxation policy, which is deeply unpopular with North Sea producers, and we thought it was a good moment to take a sector deep dive. So we're joined by Gaius King. He's a commodities analyst from Fox-Davies Capital. He has 30 years of experience working with ASX and TSX listed stocks, and he's going to give us his insightful commentary on the oil and gas sector. Over to you, Gaius.
Look, I've titled this presentation, for want of a better term, is oil and gas the best investable sector for the coming decade? Obviously, that's a rhetorical question. But a key point that I think has been missed and purposely messed around is, if it's not grown, if it's not mined, then you don't have an economy. The mining and oil and gas form the basis of every major economy globally, and there are no exceptions. As Donald alluded to, oil has popped a little bit. I wouldn't say it's been exceptional in the past 6 months, but we would contend that actually this is just the beginning of a major price escalation of oil going into the future, and hopefully we'll demonstrate why. Global oil demand, everyone is predicting, including the IEA, that it will peak around 2028, 2030. We personally believe that it won't peak for decades yet. And here is global oil demand going forward. Obviously, we had a bit of an interruption during COVID, but it's continuing to grow now. It's at all-time highs. And the reason is relatively self-explanatory. Nations with the largest growth and demand are obviously those nations growing. So the growth in nominal terms was greatest with the US, obviously, because that's already a developed nation. But if you look at the growth rates of China and India, which is shown here at 40% in the last decade, but it doesn't include places like Indonesia, most of Asia, the Middle East, Eurasia. The demand for oil is growing rapidly. And so this is sort of like the analyst's curse. So earlier this year, in a little news article note that we sort of send around semi-weekly, we predicted that there would be oil shortages starting to reoccur third quarter this year. And then, of course, the oil price declined continuously for 8 months, making us out to be barefaced lies. But thankfully, the shortage did occur in the second half of the last quarter. And this quarter, it's going to be larger, at a bit over 3.2, 3.3 million barrels per day. And the global production, nice round number, global production is probably around about, consumption production, it's around about 100 million barrels. It's actually a little bit less, about 98, but let's not worry about the little inconsistencies. So there have been supply cuts by OPEC, and Saudi Arabia and Russia suggest they've cut about 1.3 million barrels. You don't see it with Russian oil output, but you have started to see it with Saudi output. But given that output is already 1.8 million barrels short, that gives you a 500,000 barrel shortage per day. But this quarter, even if you take those cuts and even if you assume they are correct, which I don't think they are, there's going to be a minimum of 2 to 3.3 million barrels per day shortage, which can't be satisfied by existing stocks. Just to cover where a lot of the oil comes from, and again, a bit of hubris from an analyst. The biggest story for oil production, obviously, in the last 3 or 4 decades has been the US and oil shale from the US. In fact, in 2010, I think I was working for WHO, I produced a note saying that prepare for peak oil, it's just around the corner. And I was getting notes from colleagues saying, look, the USGS have said that there's these massive resources of oil shale in the US that can be tapped. And being the bit of a skeptic I was, I didn't think it was going to ever occur, and how wrong I was. And oil production had jumped from 5 million barrels a day, and it's now, I think, well above 12. But the diagram on the right just proves what's happening, that there was a lot of drilling initially, production came on long, but that drilling has continued to fall for a variety of reasons. Part of it is because there's no longer the amount of land being released to drill. And if we go to the next page, this is the Permian. This is the most productive part of oil shales in the US. And the point is that Permian production has plateaued for 7 years. So if we run into shortages, the US is not going to save us this time round. The US was one out of a box that no one saw coming, or very few people saw coming. I certainly didn't, but it's not coming to rescue. The reason why I don't think Russia is cutting oil production is simply because, you have a look here, Russian oil production has plateaued. In fact, Russian oil production is actually very old. It's very expensive, and it's declining every year, somewhere between 200 and 400,000 barrels a year. A lot of new Russian production, which will come along, excluding Eastern Siberia, will require Western technology, which Russia clearly doesn't have at the moment. They tried doing oil shales, but their drilling technology just wasn't up to it. So Russian production is probably going to decline as long as the Ukraine war continues. Let's hope it stops soon. So then the next question becomes, okay, oil production is going to, oil consumption is going to fall because there's going to be this huge arrival of EVs. And we have been non-consensus analysts on this front for at least the last 3 years. We believe this diagram, let's just jump to this diagram. The two things I just want to point out, this is the EU EV sales. The light blue at the bottom is full battery electric sales. And then the blue here, and these are old figures, these figures are about 6 or 7 months old, they are proprietary numbers. We estimated that 53% of all sales in the EU will be electric vehicles this year, was hybrids. And we've been saying for the last 3 years that hybrids are going to be the big thing, not battery electric vehicles. And the reasons are varied. Battery electric vehicles are chemistry constrained, not technologically. So yes, the batteries can get larger with time, but the range and the rechargeability and a bunch of other factors, you can change the chemistry of the batteries, of course, but they're always going to have limitations. Battery electric vehicles, and a couple of key studies out by Volvo and a couple of others, have proven that battery electric vehicles are structurally more expensive. So they're going to be a large sector of society that will never be able to afford a full battery electric vehicle. That's a fact. And the part of the key thing about hybrids is that the reason why they're outselling everything, and diesel sales are falling and petrol sales are now falling very rapidly, the reason why everyone's jumping for hybrids is that you get a lot of the economic benefits without the shortcomings. And we've said, in fact, the reason why we shorted so many of those American battery electric vehicles is that there were DOA business models. But the other key thing we'll come back to here is that the rise of China and its ability to constrain commodities going into the future, which will be critical. This next diagram we've included a lot of presentations, love it. This is Fifth Avenue, 13 years apart, 1900, 1913. No government mandate did this. People used horse and cart and then decided, and the second diagram, there's only 2 horse and carts there, and they just bought cars. They did it because it was better. And hence this diagram here. And our investment narrative is that the technology is superior and it's more efficient, and it's cheaper, obviously not initially, but eventually becomes cheaper, people will adopt it. And the diagram here might be a bit esoteric, but just to explain it, took 16 years for 100 million people to have mobile phones. And ChatGPT, which is obviously the AI thing that came out last year, it took 2 months for 100 million people to use that. And there are other technologies that come out since, and it's happened inside of a week. So technological uptake is very quick, it's accelerating, and we would expect that to continue. Okay, getting back to China. Why is China important? Well, China is following, I guess, the business model of Great Britain back in the 18th and 19th century. What it's doing is creating supply chain colonies. It's getting all those resources and feeding back into China, which are refining, processing, manufacturing, value-adding. Then they're selling out to the rest of the world. And there's a lot of pink. Pink, when I was growing up, was about the British Empire, and a lot of the British Empire was pink, I remember, on the map on school. Now pink means China. And China has the ability to tap very cheap energy sources, basically coal, and it's dominating all sorts of sectors from metals to mobile phones. You can't build an electric car anywhere in the world basically without a Chinese input. And that strength is only going to continue. And what's up against China? And this is the free trade grouping. It's blue, obviously centered around the US, and it's substantially smaller. I would argue that this region does produce most of the resources that the US needs, but only enough for the US and not enough for Europe. Europe is in the enviable position of legislating battery electric vehicles and their uptake without securing any of the resources. They were very slow in realizing what the game plan was with China. Japan saw it over 15 years ago, and they started diversifying their resources elsewhere. So Europe is in a unique problem, and they are going to have to try and find sources from elsewhere. They don't have colonies. They don't have many friends either. So they used to have Russia, but obviously that's gone away. Why are exports important? Well, if you swap the name for a country for a company, companies to stay alive and be sustainable need to produce a positive outcome. So there you have, in the green, you have China obviously producing a lot of stuff that we want to buy cheaply. You have Russia that actually has a very large manufacturing sector, but produces a lot of raw materials that they now exports primarily to China and India. And actually has just overtaken Germany as being the world's 5th largest economy on a PPP basis. And then at the bottom, on the other end of the ledger, you have the US borrowing huge amounts of money, we don't even know what they're spending it on. And the United Kingdom. Interestingly, India's there as a deficit too, but India is borrowing to build assets, to build infrastructure, and the way they're progressing, and the world's fastest economy growing 7 to 9% per annum, they will be a positive net exporter within a decade. So let's go to the oil and gas industry and try and link these thematics together. The oil and gas industry is incredibly important to the UK. It produces 200,000 jobs, a lot of them very well paying. And back in 1999, when it was at peak production, it was exporting 6 million barrels of oil a day. Now, put that in perspective, that's twice what Russia's exporting at the moment. Just think about it. Russia's the world's 3rd largest exporter, and the UK at its peak was exporting double that. And this is where I jump on the bandwagon a bit. So the current tax rate for oil and gas producers is 30%. For every other company on every other sector, it's 25%. Then just because we could, we chucked another 10% on top, which is fair enough because it's royalties. But recently we added a windfall tax. And my claim here is that it's actually a subterfuge to destroy the native British oil and gas industry. And it's not quite apparent. Yes, the total tax rate is 75%. That's very, very high. And it's created short-term dislocations. Harbour Energy saying their effective tax rate is 102. Obviously, these are temporary. It'll sort that itself out in the long term. Enquest, which is an energy provider, was 118%. But I'd ask the question, what is the difference between Labor and the S&P banning oil extraction from the North Sea and the addition of a windfall tax? In particular, windfall tax capital ring fencing, which I'll explain in the next page. But firstly, let's see where all these super profits are coming from. So this is BP. BP in 2012, 2014 was producing the same amount of profits that it is producing today in nominal terms. And obviously had a big gap there where it wasn't producing any profit at all. But the thing is, inflation has jumped by 60%. So if we were comparing like with like, you would expect BP's profits to be 60% higher than it is today, and it's not. And actually, if you go through all the companies, there's very few companies in the UK that are producing super profits that deserve a windfall tax. So then the question then becomes, okay, well, Norway taxes, we charge 75%, but Norway taxes at 78%. And I have to, big shout out to Stephen Fakur for this. I didn't appreciate the detail on this. I knew it was bad, but I didn't realize how bad. And I'll try and hopefully I'll be successful in explaining it. If you drill, let's say you drill 4 holes in Norway and you spend $100 million and they all come up barren, at the end of the year, Norway will give you $78 million back. And you can find 22 million from the capital markets and go and drill another 4 holes and hopefully you get success. In the UK, you get no cash back. It's 100% loss. But this is the sting in the tail with this windfall tax that I only recently appreciated. And there's a reason why the oil and gas industry are dead scared that they are facing extinction inside the next 2 or 3 years. So there's this article within oil and gas industries called ring fencing. Now, as you can imagine, an oil and gas company, a bit like a mining company, they drill everywhere. And a lot of the holes are not successful. But hopefully when you find something, you can claim the expense of those holes back on future production and get that money back, of course. This ring fencing, as far as I can understand, only allows the holes that you drilled in that particular field to be claimed back. Now, you think about the exploration implications of that. It becomes almost automatically impossible to make a profit to become an explorer in the UK. And I just find that utterly, I mean, this is the Tory government that brought it in. So what is the difference between Labor banning it and the Tory government creating a situation where it was completely uneconomic? And I would argue there's no difference at all. Why invest in oil and gas? Well, oil and gas, this is the S&P 500, which has a great number of oil and gas companies. They're doing very, very well. A lot of them are trading on very low PEs and they're producing a heap of cash. In fact, on a global scale, oil and gas is the most attractive, bar none, sector there is out there. You know, Apple and Google are PEs of 30. Nvidia is a P of 108 or 110 or whatever it is. So the technology have massive PEs, but energy companies are often, and let's just focus on oil and gas, are on P's of 7, 8, 9. Coal companies are on P's of 3 or 4, by the way, but let's not go there. And these are a couple of examples as of today. So you have ConocoPhillips, they're on a P of 11, they're yielding 4% per annum. Exxon have a slightly better exploration play growth, P 9, their yield is 3. But if you look at Woodside, now Woodside is predominantly gas. It's a little bit more variable, but it produces a lot of oil too. Great company. It's on a P of 6 and it has a yield close to 10. There is no company out there in the UK that's even right close to that. Santos, another great company, support the Wallabies. I'm originally, despite my accent, I'm originally from the New Zealand, so I like putting in the knife into the Wallabies anytime I can. But Santos, great company, P 9, yield of 3. And this is the cliffhanger. Because we haven't been investing in oil and gas for the best part of a decade, but they peaked at 2013, global supplies are going to be dramatically short going forward. So by 2030, which, you know, for most people is only 7 years away, production, we are going to be somewhere about 30 million barrels per day short. Now, we will find something and it might be a bit more than that, but we haven't found those yet. This, by the way, this source is the Saudi Arabian producer, obviously the world's largest producer, 10% float. So these numbers are not fiction pie in the sky. These are detailed. A lot of analysts in the background have generated this. That 106 target in 2030, I think, will be easily exceeded. That 106 is a little bit higher than IEA. And then the narrative that most people, or the zeitgeist that most people are pushing, is that oil's demand is going to drop off and we'll only need about 106 million barrels, a little bit more than today. But the numbers I'm seeing is that we could easily be 110, 115, 120. That the growth of oil consumption is growing, not exponentially, but very, very quickly. So we're going to be massively short in oil. And if you want to be in a sector that is short, commodity prices are going to go up. This is the one sector to be in. Obviously, there's going to be a bit of variability. And this is my closing slide. Sorry, I rushed this because I ran overtime last time. It's a rhetorical question, obviously. Is the oil and gas industry the best sector to invest in? And I would suggest yes. And I put this diagram here. There is no such thing as a low energy rich country. The narrative that a lot of government departments are pushing is turn off your lights, turn off everything. Factories, we don't need factories. We export them to China. We just buy the stuff back or whatever. That is not a success for economic growth. And unfortunately, it's a Western paradigm that we've been pushing for 3 decades now. And I think it's fundamentally dangerous. It's going to take decades to fix. So go oil and gas.
Okay, thank you, Gaius. So it's going to take us decades to reach peak oil and gas, and that's because economies need oil and gas. Is that the essence of your argument?
Well, that's right. So, I mean, just to take a couple of steps back, our argument at Fox-Davies has been, and we support a great lithium company. There's always
Clean
been
tech lithium, just for clarity.
Clean tech lithium, yes, yes. So we've always promoted the idea that hybrids make a lot of sense because you get a lot of the economic benefits without the material shortcomings, especially in cities. You do need battery electric vehicles. I think if you're in a major city, why not? A battery electric vehicle for short runs, it's great. But so I think the growth and the idea that you could legislate and completely ban all internal combustion engines is a fallacy, and I think that's about to be overturned. It definitely was overturned in Europe. Europe was supposed to ban all internal combustion engines this year, and the EU was just a rubber stamp, and it never happened. Germany, Italy, Poland, Hungary, Bulgaria, and a bunch of others said, no, we're not going to do it. And then the article just died. They gave some sort of excuse that you could build fuels, synthetic fuels, but it's going to be too expensive, and I would expect some rollback in the future. So the growth in other parts of the world that are developing, they're not going to go down that route anyway. They can't. Their electrical systems can't afford it. The other key thing is that a lot of them buying cars, a lot of them are developing very, very quickly. India this year is already larger than the entire UK economy. By 2030, it will be double the UK's economy. So in 7 years, it will be double the UK's economy. And it's developing at an incredible rate. China's obviously slowing down. But, you know, places like Nigeria, Indonesia by 2050 will be somewhere between the 6th and 7th largest economy in the world. So the whole idea of growth is going back to Asia and part of Eurasia, and they're going to use a lot of oil. And the truth is that we don't have the supply. So maybe the supply is so great and the prices become so great that battery electric vehicles become a necessity. I can't see that far ahead. There's too many variables. But oil and gas, I can tell you now, oil and gas is probably not going to fall in the long term much below where we are now. And I was looking at inflation adjusted. And if we go back to 2012, 2013, we're looking at a minimum price long term of $150, $160 a barrel.
Oh, crikey. I'm not sure if that's good news or bad news. It depends which side of the investment you're on, really. Let me put this point to you. Presumably those countries with their own oil and gas resources, Nigeria and so on, and their own tax revenues from that oil and gas will be the last to transition away. So why is the UK the first to transition away when those tax revenues would, well, they're attractive, but if, as per your argument, you kill the oil and gas industry in the North Sea, and then you don't get any of that, why? I'm slightly struggling with it all. Why would you do that to yourself?
You're asking the wrong person. I have no idea. It makes no economic sense. I accept the argument that the UK doesn't have refining here anymore, so it exports the oil somewhere else, and then
it drills it out of the North Sea, and then it sends it off somewhere else to be processed. Yeah,
but that's a nonsensical argument. That's a bit like saying, at the moment, we've banned all Russian oil and diesel. But the dirty truth is, the Russian oil is going to Indian refineries are exploding.
Yeah,
and we're buying a large part of our Russian oil from India. And everyone says, oh no, we're banning Russian oil. So there is no logical reason why you would crush the oil and gas industry here in the UK. And then just from a balance of payments point of view, the UK doesn't manufacture much anymore. It's exported most of that to China and increasingly to India and Vietnam and things like that. So, and we're running 3 to 4% deficits. I think I had a look, in the last 30 years, the UK has only run a surplus of 5 times in the last 30 years. And even more dire, the last government debt in Tony Blair in 2001, I think, was about 32, 33%. Government debt at the moment is about 106%. By 2030, it will be on 130% debt GDP. And then you ask the question, okay, what did we borrow? What did we borrow and what did we spend all that money on? We spent it on entitlements. And that was the point I was trying to make about India. India are borrowing more than they're exporting at the moment, but they're building huge amounts of infrastructure, housing, factories. They're really going down the chemicals route. They've refused a bunch of Chinese companies like BDY and whatever to establish factories in India because they think, well, no, because then China then controls that production. So India's going down the route. Look, we have to be our own development, our own resources we have to use. India is now actually about to overtake Australia as the world's second largest investor in mines and soon into oil and gas. They weren't even on the list of the 15. Canada, which was the world's largest resource recipient of investment in mining 15, 16 years ago, is now number 7. So the whole world is changing, and China's obviously developing a lot of Africa and importing these resources, and India's desperate to get on the train too. So we've got the great game again, where great powers are chasing smaller countries and smaller areas to get these resources. And obviously we could talk about lithium or rare earths or whatever, but oil and gas is one of those clear resources that everyone's trying to corner.
So final question, I do feel as though in terms of balance, I really ought to ask about climate change and the need for net zero and what seems a very laudable drive to net zero. Where does that all fit into this? Where does that all fit into the world as you've outlined?
It doesn't. So just to answer your question with something else I'm working on was about nuclear power. So if you read a lot of the research out there, nuclear power is very expensive and not practical and whatever. So, and a lot of the numbers just look rubbish. I know these are big consulting firms. So I went out and generated the numbers themselves, and I looked at Hinkley C and I looked at Dodger Banks. And I can tell you now, capital intensity, Hinkley C is half the cost of the Dodger Banks standalone rare earth turbine wind farms, half the price for the amount of energy that you get out. And then I created a model where I looked at 2 days in Perth, Western Australia, facing up-to-date capex, facing solar panels with a battery technology so you could store for 12 hours a day. That doesn't exist, by the way. And even when I ran through a whole lot of unrealistic assumptions, nuclear power came out about 20% cheaper again. So a lot of the numbers, a lot of the detail we've been given, I think, is a fiction because it's related to, I don't want to say it, sometimes I say it, politically, a more politically astute, a GB News way of saying it would be that it's an ideology, almost quasi-religion, but it's not based on economics. It's probably not even based on science.
Where does it come from, though? Is it, you think this is a government spin?
I think a large number of people want to believe in net zero without realizing that the amount of metals, just looking at the metals, and I wrote about this last year, the amount of metals you would need to make a net zero contribution, and you got to remember your energy prices can be double from where they are now. It's going to be 300 or 400%. We don't have 300 or 400% more mineral resources to mine to make net zero a reality. So if net zero is not a reality, you have to find energy from somewhere else. My last diagram here is there's no such thing as a low energy rich country. So the UK has lost all its manufacturing, all its resource. It's about to lose all its last steel. It's lost its mining, refining. And when you lose those sectors, it's a technological ecosystem and you lose the ability to gain from research. So any new research into electric cars, and you can see this with China now, China builds with the exception of Tesla, China builds the best electric cars in the world. They've surpassed Germany. And because they build so many cars now, the quality control of a Chinese car is now matching the average quality control and surpassing the quality control of a German-made car, because they're building so many and they have so many engineers. And so any technological developments in these new areas moving forward, you're not going to participate in because you don't have any investment in. So that's a very, very real danger, that we're just becoming consumers and we're not making anything on net value. And I can't see a system where we don't continually run deficits.
Okay, Gaius King, thank you so much. That was absolutely fascinating. Quite controversial, but absolutely fascinating. Always good to hear a different point of view. Gaius King, commodities and analyst at Fox-Davies Capital, thank you so much for joining us this evening.